Welcome back, everybody, to We Are TPM with myself, Kyle Teixeira, sitting next to John Teixeira. We are back this week to talk about housing affordability. If you like anything we talk about this week or anything John says, or possibly anything I say, give us a call, 817-818-9039. Shoot us an email at showmethemoney@wearetpm.com. And thank you all for tuning in again. Let's discuss housing affordability, John, because it kind of involved in this market, right? Just a wee bit.
100%. Top of mind for everybody, isn't it? Right? Like, not just for housing, but just affordability in general.
All
right?
pieces of the industry are paying attention to this
milk
factor.
And gas. You and I don't buy gas anymore, but I mean, it's all going up, right?
It is, and it all ties together. You know, you have, we're specifying housing affordability because of what we talk about on this podcast, but we could use token words like inflation and rates and all that stuff, but the factor here really is the most sensitive sector for interest rate increases is housing. It's the first place you feel it. It's the most. It's an instant impact on housing, because people just think about housing prices, right? And we've talked a lot about interest rates and how those changed the market here recently. But what does it mean with affordability?
Well, so I think we really wanted to talk about it from a rental perspective, right? Rental affordability. Yeah. I mean, if you're purchasing, it's definitely affecting your affordability, as we've mentioned in past podcasts, because it's increasing your out of pocket. If you're getting a loan for that home and your interest rate is higher, clearly your monthly out of pocket is going to be higher until interest rates come down and you're able to refinance. So it's kind of a temporary problem. So again, to reiterate what we've said in the past, I would say now's a great time to buy because there's less people doing it. And if you're a first-time home buyer and you're frustrated with what the market we came out of, where you couldn't, right? You couldn't compete with others, and now you can. Now you can compete. Now you can ask seller for concessions. You can do all kinds of stuff that you couldn't do before. You're just going to have to deal with a high interest rate that almost assuredly is a temporary problem.
But the affordability thing is what comes up with lenders, and especially in this case, and the reason we say it's so sensitive in the real estate industry is it is like while you're shopping as a buyer, for example, you're qualified because your monthly income, affordability really comes down to a ratio of your monthly income and how much you can afford. So, and that monthly income is fixed. So you get approved and you're shopping for a house at say $300,000. And rates go up tomorrow, and then mortgage rates the next day follow. Your interest rate on that mortgage, what you're approved for, just went up.
Your qualification just went down to 290 or 285 or something like that.
It went proportionally down instantly. And this could be, you could have an offer out, and next day Fed changes rates, and now you can't afford that house that you were at the top of your approval for. Yeah.
So good point. And to your point, there's a cycle, right, that we want to talk about. There's an affordability cycle. And where we are in that cycle is everything's going up. Rents are going up. Interest rates are going up. The cost of goods are going up, right? I don't know anything that's not going up. Insurance is skyrocketing. Everything that has to do with a home especially is going up. Yet
affordability is going down.
Affordability is going down, yes. Yet the reason why it's going down is because
all those other things are going up.
It's because people's incomes are not going up proportionally with inflation right now.
That is correct.
So they did for, I believe, through 2020, 1920, there were, I think, rates, income rates were going up. I think we're actually going up at a pretty good clip during COVID, but that came to a halt, and it's not keeping up with the inflationary rate. So that is what is creating the higher affordability problem, is because while everything else is going up, the wealth and income of a families is not going up at the same rate.
Yeah, we had there was a small bit there. I wouldn't say it outpaced inflation. It's hard to say, but there was high job turnover after COVID, which helped spike incomes and job rates. Just
what did we call that? The resignation?
The Great Resignation.
The Great Resignation.
I don't know if that's what we call it, but that's what I've heard it called.
Yeah.
But yeah, with rents, it's interesting. Rents have been increasing, and rents have increased a lot over the last couple of years. But the interest rate increases at the rate that they've gone up have actually surpassed, at least for affordability, it's made rents actually more affordable than purchasing, just as a flat monthly cost. So, and you can look that up on if you want to. But yeah, that crossed in about 2022, and we haven't seen it cross back down. And this isn't to say that there aren't all the reasons we always talk about to still purchase a home. It's just strictly that affordability matrix is because, when you buy a house, even with the interest rate going up, with insurance almost double what it was, in some cases more than that, what it was 2 years ago, that piece of your escrow payment goes up.
Mm-hmm. Dramatically.
Yeah. And taxes, taxes have gone up.
It hurts landlords. Hey, you know what? I want to talk about that. I want to get on a soapbox a little bit. Can I get just a little bit on a soapbox? I mean, I've been on the soapbox before.
You ask, but you're going to do it anyway. So let's go.
If you say no, then I won't do it. I promise. So, because I've just had this conversation this morning, and it seems like I have it often with landlords, and it's understandable conversation. My taxes went up 11% last year. My, as you said, insurance rates, they've gone up 25, 30%, right? It's insane how much insurance rates have gone up. That is that is affecting the bottom line of homeowners and especially landlords that are counting on the cash flow that they make every month from these homes. And they're coming to us and saying, well, we need to raise the rent. Mm-hmm. And you and I have talked about this. We've actually had a podcast directly about this subject. I forget, maybe you remember what it's called, but, do those things correlate? Just because your expenses have gone up, does that mean that should be rolled into the rent? And my answer is no, they shouldn't correlate at all, even though they do in your mind, they correlate. You want your rents to be to match whatever the current market rate is. And I'm explaining this, Kyle, because this goes into the next part of the cycle of affordability that I want to talk about.
It does.
If the market rate is, I don't know, $2,000 and you're at $2,000, right? You don't want to move somebody up to $2,100 just because your taxes and insurance went up, because they could easily go down the street and get something for $1,900 or $2,000. So why would they pay you more? And now you've got a vacancy, which is going to cost you $100 to $200 a day, depending on how much of a mortgage you got. That's going to cost you way more than the $100 a month that you're trying to get out of them. 12 days of vacancy will take up that whole lease, right?
Well, and that does tie into affordability because it makes things less affordable for the landlord. And one common, and we're talking about this because just because their mortgage isn't changing, right? Those are fixed in most cases, but the taxes and insurance is a bigger piece of your monthly cost as a landlord, as a homeowner.
Sometimes it is, isn't it? It's at least as big.
At least in Texas, especially because because our property taxes are a lot different than some other places. It becomes a big proportion of your monthly payment. In some cases, it's almost half your monthly payment.
Mm-hmm. Yep.
In a lot of cases, with interest rates, if you have a new one, it's maybe not half. But if you're at 3% from back when things were 3%, and your standard 3.2, they're getting close to about half that monthly payment.
Yeah, thank you, Texas. It's nice. It's nice when you have a fixed rate and you know what your payment's going to be for 30 years, unless you live in Texas and half of your payment goes up every year.
Well, we could get into how that's based on the appreciation and everything, but appreciate your appreciation. Yep. Just look that episode up. We won't talk about all that. But you wanted to talk about the affordability cycle. So
I mean, we're in a cycle, right? So we're in a cycle where things are going up. Incomes are going down. That makes affordability go higher. But you know what's happening is some rents are still going up in some neighborhoods and have been. Some are starting to level out. Some have actually started to go down. It's really finicky and it really is dependent on the particular neighborhood. But that's kind of what starts to happen before everything flattens out, right? And I'm referring right now to rents, okay? And I'm thinking about, because I really want landlords out there to be thinking about this. As rents have gone up, and they've been skyrocketing over the past 5 years, I feel like everybody's rent has gone up 10%. I mean, we're down to most of the renewals I'm doing right now. If there's an increase, they're 2 to 5% is about where we are right now. But still, that's an increase during a time when we know that there's affordability problem. And here's the problem. We know there's an affordability problem. We know that it's probably going to come to a head, yet the market rate is still ticking up. Not at the same rate, but it's still ticking up. And as long as that happens, we're going to get more and more people that are forced to pay these rents, but eventually come to the logical conclusion that they can no longer afford these rents.
Yeah, and
their budget will not afford it.
The rents are in a period of consolidation, but it's flat or up because it's held up by when the affordability of purchasing a home goes down so quickly, it holds up the price of rents regardless, because so quickly people are getting kicked out of the ability to buy homes, and then what are they going to do? They got to go rent. We talk about that all the time, but like rates just went up again like 2 weeks ago,
and they expect them to go up one more time.
But like that instantly kicked a whole bunch of buyers out of the market. Rates went up. All right, now you got to go rent. We tried, got to go rent.
Housing market isn't dead enough. We need to kick it in the gonads one more time.
Well, I'm not saying we want to go one way or the other with that, but ideally, the affordability of purchasing a home, it should be less than renting a home. And before 2021 right or 2020, I don't remember the exact year, but all the way back to 2008, it was, but it was quickly skyrocketed to not being the case.
It is to own at this moment.
And it affects the purchase market too, because like home rates going up is heavily pushed by low interest rates too. Because if a $300,000 buyer can now afford a $350,000 house, and the house they want doesn't change, they want that standard 3.2, then they can pay a little bit more for it, and that helps push home values up. Well, on the other side of that, affordability getting dragged down can help drag or stop the increase of home prices and start dragging them down. I mean, that is part of the reason they do these high interest rate hikes, is this is their intention, to fix affordability. So what are you plugging Podcast Mansfield now?
Yep, I am.
Love it.
The other part of it, Kyle, is we have done, and this is kind of next stage of the cycle that's glaring to you and I, right? Because we're in it every day. We do more evictions every month than we probably did every year previous to this market. Yeah,
and there's considerations for landlords, where how quick you are with that, how much demand is out there. But you don't even need to speak to us. I've been speaking to constables all over the counties here, and they're all telling me, and they're going out of their way to tell me that like they are scheduled out on evictions, weeks out on evictions, and they never done that
on set outs, which is like the last stage of eviction. Step. That's like I'm putting your stuff on the street corner on the street and forcing you out of your home.
Involuntary repossession.
That's the last step in this whole process of eviction, of getting a home back, that hopefully you never get to. Like, you try not to get there, but yet the constables are 3 weeks out on getting those done.
Yeah, and even they've said I'm talking to constables who've been doing this for 11 years, 15 years. The other day was 19 years. They're like, I've never had this, even half of this or close to this.
Okay, so
in all my time doing
great point. And that is our next, that is, again, a testament to us being in that next part of the cycle. So while market rates may still be ticking up, the market, due to eviction rates and what constables are telling you, is telling us that it's not sustainable, and we're at that point where it's not sustainable, and that's why we're having to evict so many people.
Well, and it's forced downsizing too, because there's still a lot of turnover, because all those people getting priced out of the market now have to go get something cheaper. So that indirectly, it's all part of the same phase of the cycle. The higher rent houses are harder to turn over, harder to fill, because you just basically take all categories of tenants and drag them down a leg. Then now you have way less demand in the higher income bracket, or the higher rent bracket. So, which ironically is still being held up by home price, or the home affordability problem. Those same people in those same income brackets are looking at a 9% interest rate on a $700,000 home that they may normally buy, and they're like, yeah, that $3,000-$4,000 rent doesn't look so bad. So,
yeah, I mean, I think we're there. I personally, just based on what you and I were just talking about, doesn't it feel like we're really close to that peak of affordability where it's not sustainable any longer? We shouldn't see rents. I know the interest rates are going to go up more, so that part of it we know. We're almost assured, because the Fed told us that they're going to do one more, but whether they do or not, we don't know until they do it. But with rents, we know that it's got to be flattening out. As a matter of fact, I was looking at our renewals this month. We had like 14, 15 renewals that we did this month. And I was looking at the remaining renewals just this morning, and I was noticing that we have about 5 or 6 of them that we didn't raise at all. We do like a month-to-month premium if you're going to stay month-to-month, but for the most part, for their lease rate, we didn't raise them at all, which tells me that we are at market rate already, and it's flattening out.
Well, yeah, we can talk about all these factors that feed into affordability, and we're only even consolidating this to housing, and there's a ton of factors. But yeah, I mean, the housing is the direct, most sensitive thing to interest rates, and that's really what the Fed wants to see. They're going to keep raising things until they see something break. You just don't know which one's going to break first. So, but we're watching it. I mean, because the precursor to evictions, and we just talked about the huge change in the amount of evictions and everything like that, is delinquencies. Delinquencies is increasing on, the precursor to that is increasing delinquencies, and we're seeing that too, because the affordability of those rents is going down. So,
what do you think the Fed is looking for? Can we get opinionated now?
We can get opinionated. I mean, they're looking to break things, they want the housing prices to go back down, because I mean, if they don't go back down and you drop rates again, then they're going to start going back up at the same rate. So if all they do is halt the increase in home prices, and then they have to go back down, and all they did is delay what was already happening.
So this is their answer to a supply and demand problem that they're not solving, that nobody's solving. Builders can't solve it fast enough. They can't build fast enough. Even in this economy, the only ones doing good right now are builders.
Yeah, and their margins are slim too. So, and they can give away. That's the thing. Builders are the ones doing well, because they can give away all these concessions. They can pay all your closing costs. They can do this, and this to make it as cheap as possible to get that house. But there's still the affordability problem. Can you get approval for that house? Or by the time they spend, what's the affordability going to be in 6 months when it takes them 6 months to build this $300,000 house, and now average affordability is in the 250s? Maybe they should have built a $250,000 house. So they're chasing a moving needle just like everybody else, because their timeline can't be sped up into months. And the Fed, you can't trust the Fed.
Yeah.
You cannot fight the Fed. That's probably the best advice ever. But but that's why people with cash are buying things up. Because this is the time for that.
This is the time. And if you're an investor, this is the time, whether you're using your own cash, whether you're leveraging or not. Just like I said, for the homeowner that wants to become a homeowner, it's also a great time to become an investor because you can get better terms. You can get better, when I say terms, other than the interest rate, but you can get better sales price. You get better, you just get better homes. You have more, it's not so competitive out there. So it's more of a normal type of market right now. Now's the time to go out, snatch some stuff up. Don't worry so much about your negative or your cash flow that's not there, because this will all turn around and it'll be there. It's a temporary situation.
Is this the last phase of the affordability cycle?
No, I think we're at the top of it. I think then we start to come down to where maybe taxes. Let's assume that we go through this normal cycle. I don't know if we'll do it this term or the next term, but what normally happens is somebody else comes in and they bring taxes down. Maybe they bring interest rates down to stimulate the economy. They do things to bring more business in, bring consumer confidence up. Those are the things that somebody needs to come in and start doing to get activity going again. And once that happens, then incomes should start going up, and that should bring the affordability problem down. Now, we still have a supply and demand problem. So even if all those things I just said happen in the future, it is still possible that because of the supply and demand problem, that affordability remains an issue. If sales prices start to skyrocket up again and rents start to skyrocket up again, at the end of that cycle, you don't know exactly how that's going to play out.
Well, and that's why I say don't give a generalized opinion that it's until they break something, because that is a hard problem to solve. They fight each other. A supply and demand problem in the housing market and the rental market, and an affordability problem. They're factors that have to be fixed individually. They can't be fixed
they're
as
competing,
a whole.
Yeah,
they all compete.
But they do affect each other.
Yeah, so
they absolutely affect
you got to break
each other.
one and then try to fix the other two as they're falling apart. So I mean that's what we've seen over the last year. It's been slow because of the supply and demand problem. That's why they've done these hikes so quickly. I'm not saying one way or the other what they should be doing here, but we're going into an election year too. And I heard the other day from somebody that people think that's going to change the strategy of the Fed. I've heard that a couple of times over the last couple of weeks, and I explained, I'm like, it doesn't matter who controls Congress. It doesn't matter who's sitting in the executive branch. The Fed isn't a government agency. They are not mandated by anyone to do any specific thing other than...
No, they're controlled by the caliphate, right?
We're not going to get into who controls the Fed or what that third party entity does, but they're mandated by Congress to control inflation and the job market. So they're going to do what they're going to do regardless of who's in office, is what that comes down to. So, I mean, politics is politics. We're not getting into that, but all you can do is listen to what they say. And they say the same thing we're saying as far as affordability. It's out of hand. It's completely out of hand in pretty much every industry, but the housing industry is the bedrock of what they have to target. They have to target the housing industry with interest rates because it's an instantaneous effect.
Well, I know we are really careful about, especially on this podcast, we don't like to get political, right? I mean, I think everyone probably knows where we stand or what our opinions are, but I want to say this. One of the things that's clear about the actions that happen are that whoever is in control of these things, right? Whoever is pushing all the buttons to make all these things happen, they clearly are not of the mindset that they want to build wealth through the middle class. This country is as great as any society on the planet has ever been because it is literally the only society that has ever propped up the middle class over all other classes. There's more wealth in the middle class than anywhere. And if you take all that money from the middle class and you separate it and you give it to the poor and the rich and leave the middle class without the ability to build wealth, then you become like every other society on the planet has ever been. And we already know over and over again that that does not work as well as what we're doing right now. And it seems like all the things that are happening to affect that right there. They're happening. All the things that are happening are taking money from the middle class and moving it to the poor and to the rich. And I think that's a very bad thing.
Well, and it starts.
I think you all should vote accordingly.
It starts with housing because that affordability matrix for the income ratio for renting versus home purchasing, it ties into the same thing because they
don't want individual home ownership.
Yeah, because you can't buy the homes, then
some don't want
the big money is going to buy them up for cash, and they're going to rent them out for the higher rates, and the rents are still going to keep going up because people can't afford houses, and at that point they can drive up home rates or do whatever they want. So
our current administration came out and said specifically that they think individual home ownership was a bad thing, and that they think or individual investors are a bad thing for the economy, and that they want institutional investors only to own all the rental properties.
Yeah, inflation's also transitory, so
just saying.
They say things, but affordability is at a low. Just kidding. Technically, depending on what ratio.
I think you're hitting your
at.
climax right now.
Yeah,
I really do. It feels like you are. I hope you are. I hope we're hitting the top of that affordability mark and we start sliding back down the other end, or at least leveling out. You know what I mean?
Because and interest rates, like you said, the builders are doing great, but then if these houses aren't moving, they're paying high interest rates on these on these builds and their material costs and all that stuff. So we're seeing it, and it's starting to go quickly because we're in that time of year where market activity slows down naturally, regardless of the cycle. We're October, November, got the holidays coming up. So those things can help expedite whatever spike or decline we have going on. So, I think we've killed affordability here. So.
I think so. I think we did a good job on it. Good job. Fist bump early.
Look at that self-gratification. No, I'm just kidding. Well, if you like anything we had discussed today, or want to talk to us about affordability, or what you can afford or what you can't, give us a call. 817-818-9039. Shoot us an email at showmethemoney@wearetpm.com. And Kyle and John are out.